Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And by now, you probably know that my name is Goose, but joining me on today's show was an amazing guest. Her name is Archana Manapakkam, and she is the Principal of Archway Legal. And today, we discussed lots of stuff, not least of which that Gabby and I want to go to outer space. But really, to the point, is that we covered the 4 key benefits of investing in trust. So if you're someone who's ever thought about things like how to get more tax benefits out of your portfolio, or how to think about passing your property portfolio onto your kids, or perhaps you've just thought about investing in trust and you want to get a little bit more information about that and sort of like, why even would you bother doing that? Then there's a lot of gold to uncover in this episode. In fact, I actually learned a lot in this episode. I don't want to give it all away, but we covered things like tax benefits, CGT discounts, asset protection, estate planning, all kinds of different stuff. We even talked about what a trust even is, and I think you'll be surprised by that definition from a legal perspective. So I really think that given the conversations that I have a lot of the time with a lot of investors, a lot of people talk about trust, but they don't really understand much about them. So this is a really good entry point for you to start to learn a little bit more about what they do and how they work. Now, forewarned is forearmed. We had a couple of technical issues on this episode, which means that Archie's audio is not awesome, right? It's not fantastic. But lean in, turn the volume up, and really try and tap into the wisdom and the gold that she is giving away. This is the kind of stuff that you normally have to dig really, really hard to find. So I'm very proud to be able to present this to you today so that you can really start to learn more about how this kind of stuff works. Now, of course, if you've got any feedback, shoot that feedback through to hello@dashdot.com.au. And of course, if you need any help to build a scalable, profitable property portfolio, then just reach out to us too. Just head to dashdot.com.au, or in fact, go to the investorlab.com.au where you can access more episodes, resources, tools, guides, all of that kind of good stuff. And there's also a contact form on that website, webpage too. So without any further ado, let's get stuck into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is a very special guest. She is a tax lawyer, a private wealth structuring and asset protection specialist. She is the owner and principal of Archway Legal. Archana Manapakkam. Have I got that right? No, Manapakkam. Welcome to the show. How are you?
Good, thank you, Goose, and nice try with the name.
I totally butchered that. I absolutely butchered that, and I apologize.
It's totally fine. Just call me Archie.
Okay, easy, Archie. Archie, thanks for joining me. We've had the benefit of having a few conversations previously, and one of the areas that you are a specialist is in structures, trusts, wealth structuring, and all of that kind of stuff. Is that right?
Yes, that's correct. So, trust is people throw that around a lot, but they don't necessarily know what it means. So I take pleasure in actually explaining it to people and setting it up in the way that they want it to be set up and in the most suitable way for what they're trying to achieve.
Awesome. Okay. So what might be useful is if we just get a bit of a background, like how is it that you came to be a specialist in trusts? Like what's your background? What's your story?
So I started off as a tax advisor at one of the big 4 accounting firms. That was about 12 years ago. Mm-hmm. And then I moved into some well-known CBD law firms in Melbourne. And I did that for another 10 or so years. And then last year, I went out on my own. And it's been a wonderful experience getting to actually meet people and be more invested in their business and be more agile in how I can service their needs. Awesome.
Super. It's good. So just to be clear, so you started your own business so that you could be more agile. Is that what you're saying?
That's right. So it's, one thing working in a big firm and being sort of like, I guess a cog in a big machine. And I enjoy personal interaction with people. So being out on my own, I'm actually able to meet people, be more invested in what they're trying to achieve. And you don't have to, schlep all the way into town to see me. I come out and I see you.
Awesome. You're not going to see anyone at the moment, right? Because as we record this, we're in the middle of another lockdown.
We're in lockdown. That's right. So that's sort of how I got into tax. But in terms of trust, it was sort of a natural thing when I sort of moved into the more high net worth space. So moving from a big accounting firm where it's dealing with multinationals, and then moving into the private wealth space. And trust is a really big part of private wealth.
Yeah, totally. And so let's start digging into that then. So a trust, let's firstly talk about what is a trust. And I'm interested to know, because you said you started specializing in that when you started getting into the high net worth space. Is that correct?
That's right.
Does that mean that trusts are only relevant if you're a high net worth individual, or is it something that...
No, not at all. It means that that's how I started getting involved in trusts.
Right.
But then I see more and more people use it. There are a lot of trusts in Australia. If you don't know, because there's no register of how many trusts there are, we don't maintain that in this country. But it's I think people are finding increasingly what the benefits are of having a trust, and it's something that a lot of accountants will also advise. So it's often used for investment properties as well. So certainly not just people who have loads and loads of money, though they might get the maximum benefit from it, but even for people who want to buy their second, third, fourth, fifth property, that sort of thing.
Okay, awesome. So let's start super macro, because there's lots of... I could go winding down a very deep rabbit hole on any of these little niche components of like trust and all of that kind of stuff. But let's start super macro. For a lot of people have heard the term trust, particularly property investors. Most property investors that I have met, and I have met a lot of them, don't really understand like what actually is it? Like what actually is a trust? Is it a company? Is it some... How would you define a trust in its purest form?
So that's a really good question, Gus. And it's amazing how many people have trusts and still don't understand what it is. So a trust is not a separate legal entity. It's actually a relationship. It's a relationship between the legal owner of something. So it's a relationship between a trustee, a beneficiary, in respect of property. So with a company is a legal person. You and I, obviously, we're legal people as well.
Yeah.
Maybe we're not both lawyers, but we're people. A trust is not a person. A trust is a relationship. And that means that if you got income or profit or gains in a trust, it's not taxed in the hands of a trust, because a trust is not a person. It's either taxed in the hands of the trustee or taxed in the hands of the beneficiary, depending upon what you do with that money.
All right. So at risk of going really complex here, because that's a very interesting thing you pointed out. So I am a person and you are a person in all legal pretense. And a company is also a person in legal pretense, correct?
Yes.
Right. But a trust is a relationship. So it's basically, it's like saying, it's like having a relationship status between a financial mechanism. Is that kind of a understanding? Am I sort of saying that in a layman's terms well enough? Let's break that down, because you say a trust, and like a trust, the way I think about a trust is I think about it like a bit of a bucket, right? I'm like, it's a container. That's the way I think about it. And I might be thinking about it incorrectly, right? So, but you're saying it's it's basically the bonding relationship between two entities. Is that easiest way to think about it?
In respect of property. So
in respect of property, but when you say property, do you mean real estate, or do you mean any owned property?
Property of the trust. So,
yeah, so property could be intellectual property, it could be shares, it could be any...
It could be money. So often when you set up a trust, the initial property is a settlement sum.
Yeah.
So that money actually needs to be handed over by whoever set up the trust. Otherwise, the trust doesn't exist.
Yeah.
So the trustee has legal title to the property, but it's held for the benefit of someone else.
Okay. What can you explain the difference between a trustee and a beneficiary? Because I know that most people, when they might understand, okay, I'm going to set up a trust, right? And I guess I'm just going to be the trustee, right? But maybe they're the beneficiary, or how do you define those two terms? Like if I was to go and if I was to say, hey, Archie, I want to go and set up a trust in order to buy some real estate, would I be the beneficiary or would I be the trustee, or would I create a company to be the trustee so that then I would be the beneficiary? Can you just talk to that for a minute to make that a little clearer for people?
So if you can be a trustee individually, or you can be a trustee, you can set up a trustee company and you can be the shareholder director of that trustee company. There are some benefits to using a trustee company. For example, from a succession point of view, it makes things easier. And also it adds a layer of asset protection as well. And if you're in that capacity, either as a trustee, and when you're exercising those powers, you're doing it as a trustee, but you can also be a beneficiary of the trust. So you can, what that means is if it's a family trust, so you will have in the trust deed, when you set it up, it'll say, this is a trustee and here are all the potential beneficiaries. So it'd be maybe you and your wife are the main people. And then there'll be an extended class defined by reference to those two people. So maybe your children will also be included, other entities that you control, like your companies, your trusts, that sort of thing. And you can potentially receive distributions from the trust. Okay?
Okay, so you can be a beneficiary without being a trustee.
Yes. And you can be both a trustee and a beneficiary. But I know that in some trust deeds, it'll exclude. It's no longer strictly necessary to exclude someone from being a beneficiary if they're a trustee. But some old trust deeds will have that for various historical reasons. And also that doesn't apply if the trustee is a corporate, is a company, because you're not a trustee in your own individual capacity.
Okay.
Is that confusing? Have I lost you?
No, you haven't lost me, but I'm just trying to think, if someone's driving along in the car, listening to this, are they going to be able to map that out in their heads in the right way is kind of what I'm thinking.
So if you're going to set up, if you've identified a property you want to buy.
Yep.
But if you're going to set up a trust, you can be either a trustee or you can be the shareholder director of a trustee company that you're specifically set up to be the trustee, which holds the legal title to that property. And you can also be one of it's objects. So one of the potential people that the trust can actually benefit.
Yeah.
The benefit in the sense of like making distributions of rental income and maybe upon sale, distributing the capital gain from that sale.
Okay. So if we think about it like this, beneficiaries are the recipients of the benefit of the trust.
Sure.
And the trustees are essentially the operators of the trust.
That's right.
Okay, cool. Makes sense. And so I know this is a little off topic from what we were planning on. What's the difference between a family trust, discretionary trust, and a unit trust?
Okay. So a family trust is often used interchangeably with the word discretionary trust. Okay. So it means that the trustee, there'll be a number of potential beneficiaries. No one has an actual entitlement to a distribution. So you don't actually have an interest in the property. The trustee does not have to distribute to you. The trustee has a discretion to distribute to anyone who's named as a beneficiary. Whereas with a fixed trust, the beneficiaries are entitled to a fixed amount from the trust in terms of both income and capital. And a unit trust is a type of fixed trust. It's unitized in the sense that they're units, but those units carry with it a fixed entitlement to income and capital.
Okay, so it's fair to say, and maybe you can correct me, but the way that I see how the usages of unit trust versus discretionary or family trust is that if you were going to go in a non-relational partnership with somebody else, so for example, if it was a joint venture project or something like that, you would want to own independent units. However, and the reason discretionary is more of a family trust is it's probably going to be defined that you've got some ongoing relationship with that person, and the discretionary distribution of benefits is going to be a little closer to home. Is that kind of a fair statement?
Look, I think so. You need to be careful about how you structure property development projects. So we're not gonna venture too much into that territory, but that's broadly correct. So if you've got a discretionary trust, often it will be people who are members of your family. So that's why people often use the word family trust as well. But before we continue any further, I just want to quickly mention that everything that the whole discussion today, it's what I'm saying is it's just for general informational purposes only. So it doesn't constitute legal advice. And if you want some legal advice, please see a lawyer. You can come to me. You can go to anyone else. But this is just for general information.
That's a good point, Archie. And I just want to point out, if anyone is listening to the Investor Lab and using this as their like financial advice, their legal advice, or anything like that, I think you need to go and see someone more than just you need to go and get some like perspective, right? This is the whole premise of this show and the series and everything that we do is to provide fertilizer into your mental garden. It is not to dictate what you should or should not do. So always seek professional guidance and advice on all of this kind of stuff. So I'm glad that we got that in there as well. We've talked about beneficiaries, Archie. So sure. What actually are some of the benefits? Like why would someone want to, we'll stick to discretionary trusts because I think it's a little bit more in line with property investing generally and how most people are going to be thinking about family trusts and stuff. So why would anyone bother? Like why would someone invest in a trust? Why would they use that?
So there are a number of reasons, both from a tax and asset protection point of view. So we can start with tax because I know a lot of people bang on about asset protection and people don't want to necessarily hear that. They think about, scaremongering. So I'll come back to that part, but we'll talk about the tax side of things. Some of the benefits are things like income splitting. So if just say I own a property personally, and I derive all of the rental income and investment property myself, and it's taxed at my marginal tax rate. Now, what I might want to do is I might want to set up a trust for and have the beneficiaries as myself, my partner, and my children, and all my companies and other trusts that I might control. So what I might do is I might split the income between myself and my partner and take advantage of whatever different tax-free, lower tax rates, that sort of thing. Mm-hmm. Marginal tax rates, it steps up. My partner might be on a lower marginal tax rate. I would be really careful about making any distributions to children. I don't have any children, but if there are minor beneficiaries, you're not going to be trying to distribute $18,000 to each of them because it's a tax-free threshold. They won't get it. It'll be taxed at the top marginal tax rate because there's an anti-avoidance rule. It's to stop people from doing that. So please don't make distributions to minor beneficiaries. It just won't work.
When you say minor beneficiaries, do you mean minor as in age, as in young people? Or do you mean,
yes. So sorry, slipping into legal language, but under 18.
That's okay. I'll pull you up on it. I'll break this down. So under 18, is that what you're saying?
Under 18.
Okay, so under 18, you're not really going to get, because everyone talks about that. They're like, what? I'll just pay my kids all the money and then,
No, so unfortunately, no, it doesn't really quite work. The rates are for minors, it's up to $416, you pay nil, but $417 to $1,307 is 66% for every dollar over $416. And if it's above $1,308, it's 45% of the entire amount. And that's 45% plus the Medicare levy of 2%, so it's 47%. And the trustee pays it on their behalf, but there's really, unless you're distributing pittance like $416, it's just really not worth it. But you might have a corporate beneficiary. So you might have a company, and if you receive some income, you might want to go and distribute that to a company, and it's taxed at 30%. Maybe you're on the top marginal tax rate. Maybe your partner's on the top marginal tax rate. Maybe you go and park the funds in a company.
We've just stepped into some very interesting territory there, Archie. That is very interesting to me. So let's dig into that. So you can have a corporate trustee, which is basically a company, which is the operating entity for the trust, right? But you can also have a corporate beneficiary. right?
Yes. People often call it a bucket company. You might
Yeah.
hear that thrown around a lot.
Yeah. And so a trust cannot retain funds or profits in a year, correct?
So it can, but the problem with that is that if you retain it, so remember how I said that income is taxed either in the hands of the trustee or the beneficiary? If you retain it in the trust, it'll be taxed in the hands of the trustee at the top marginal tax rate plus Medicare levy of 47%. So you wouldn't want to do that. You'd want to distribute it out, in which case it'll be taxed to the beneficiaries.
Okay.
At whatever their rate is.
Okay. So if you are someone who has a higher income, right, and you're already like, damn, I don't want to pay any more tax, and so you might be thinking, and which is why some people might think about negative gearing, because they're like, look, I want the benefit of building wealth in property, but I don't want to have to pay additional tax. And so you might be thinking, well, if we create a cash flow positive property portfolio within a trust, it's gonna be producing more income, and that's going to be then distributed to us, and there's going to be taxed at a high tax rate. Instead of getting that distributed to you or your partner or whatever whoever the beneficiaries are, you can get that distributed to a company which can retain the funds at a lower rate.
So you'll want to be careful about what you do with that fund. So if those monies are never paid to the company, or if it's their loan backed by the company to the trust, you've got a lot of tax problems there that you need to get some specialist tax advice about. But if you just leave it in the company and maybe go and buy some shares in the company or something like that, at some stage you'll want to pull that money out. So maybe you pull it out over time when you're, retired or something, and you're, on some, on paying, whatever low marginal tax rate. You might want to pull it out over time, or maybe your children are, older. They have to be shareholders, of course. Dividends can only go out to the shareholders. But you can pull it out over time. You'll have to get the money out at some stage.
Okay. So, but it's not as simple as putting it into the company and then taking it from the company and putting it back into the trust to buy more property.
No. So you need to, if you're going to do that, I don't want to get into it. It can be treated as a deemed dividend. So you need a proper loan agreement between the company and the trust. And you should speak to a tax lawyer about getting that drafted.
I know that we've gone way tangential, but I'm fascinated by all this kind of stuff. Like what really interests me about this topic is how to think about the flow of capital, right? So where do we put it? How do we use it more efficiently? And then how do we create, legacy? How do we create a legacy structure and all of that kind of stuff? So thinking about, well, what happens to the distributions and how to put money back in and how to circulate that and how to get the maximum benefit out of it is something that I'm really, really fascinated by.
So that's one of the benefits, Gus. I'll just quickly touch on a couple of the
Okay,
others.
yeah, awesome. Perfect.
And then because obviously, people really want to know why they should do this, right?
I'm glad, you know what? Can I just say I'm glad that you're keeping me on track. So thanks. Go on. What are the other benefits?
So the other one is the 50% CGT discount, capital gains tax discount. So you need to be really careful about this. So it's available. It'll be available if you're investing in real property for a long term for the purpose of deriving income. It's not if you're in a property development business or in a trading, you trade in land or something like that. If you're buying property for the long term to derive rental income, if you hold that property in a trust for at least 12 months and then you sell it, you should be entitled to, again, for general informational purposes only, not legal advice, what's called a 50% CGT discount. Basically, if you make a capital gain, only half of that capital gain will be subject to tax.
Isn't that the same? Isn't that the same if they didn't buy in a trust though?
Sorry?
Isn't that the same? Like if I just went and bought it as an individual without a trust, is that not the same?
Yes, but you can also still distribute that and split that, can't you?
Okay.
That's by yourself. So, but the thing is that you actually have to get that capital gain out to individuals. You can't park it in a company, otherwise you won't be entitled to that.
Yeah, but you can distribute the capital gain more efficiently.
That's right.
Okay, awesome. Yeah, so rather than it getting all lumped in one place, you could distribute the capital gain more efficiently at a lower marginal tax rate.
Yeah. So,
Okay.
you'd need really careful advice and documentation around that if you want to make sure you can get,
Which
because if you keep doing that, but you flip everything one day after 12 months, then the ATO is probably going to look at that and go, really, are you really holding it for the long term, or is it something that you're buying for the purpose of making a profit in the short term? And the final thing is, if you got some assets, and we'll probably come back to this if we have time, but if you might sort of make losses in one company, so it might be negatively geared in one trust, and there might be another trust that you make, gains in. So what you can do, subject to making what's called a family trust election, again, speak to your tax lawyer about what that means, you can actually distribute the gain from one trust to the loss-making trust. Now, again, there are some tax rules that you need to comply with in order to do that. And you need to make what's known as a family trust election. So those are the tax benefits and the asset protection benefits. Well, if you're a high risk person, if you're a director of a company, for example, you probably won't want to hold assets personally because you could get sued. So if you put it in a trust, if you go bankrupt or for whatever reason, those assets are set aside. They're not available to satisfy your debts. Again, that only applies to investment properties. If it's your main residence, for various tax reasons, you'll want to hold that personally.
Interesting. Okay, so we're not going to have time to cover all the stuff that we want to talk about. So we'll reside with that, I think, for a minute. So if you have one trust which is loss making, and you have one trust which is profit making, you can distribute the profits from one trust into the losses of another.
Sure. Yes. So that means that you won't necessarily. So you have to make, like I said, a family trust election. Yep. So you need to specify a particular person, and that means that you can only make distributions to members of a family group for both of those trusts. But yes, if you do that, then you can inject your profit from one trust into a loss-making trust, and you can use that to absorb the losses, and therefore you won't be paying tax in the profit trust.
Fascinating. I can see that's good. That would definitely have. I can see there'd be some really interesting ways that could provide a lot of benefit. I think what you touched on there, like from a business owner perspective, most business owners who want to invest in property, I believe, should be looking at creating a trust structure, just so there's separation between them as an individual plus their property portfolio from a risk mitigation perspective. Because even if business is going well, like businesses do fail, like that happens, right? So from a risk management perspective, I think it makes a lot of sense. One of the things I want to jump to estate planning really quickly. And I know that we could talk about this specific topic for an hour, I reckon, but because I think one of the benefits, because you mentioned the tax benefits distributions, right? You mentioned the 50% CGT discount, and you also, which also ties in with the distribution benefits, because you can distribute the capital gain more effectively, and then you've got asset protection, right, as key benefits. What about the benefit of estate planning? Because I see that as one of the intrinsic benefits of it as well. Because a lot of families go, look, I want to build wealth. I want to be able to pass that wealth onto my kids and their kids. So, what can you talk to about trust and estate planning from that perspective?
So, I'm going to differentiate between trusts that you've set up during your lifetime and trusts called testamentary trusts that you'll set up upon your death, under your will. So we're not going to go into that. We're going to talk about trusts that you've set up in your lifetime for investment purposes.
Got it.
So with that, you need to be aware that the assets of the trust are not your personal assets, so you can't leave that in your will. Okay? So what that means is you need to think about how you're going to pass control of that trust once you die, or once you lose incapacity. We'd all like to maybe go to bed one night, die of a quiet heart attack, and that's it. But what happens if you get
I'd rather
dementia?
not. Just to be clear, I'd rather not do that. I'm
Just
not.
live forever. Live forever.
Yeah, I'm going for the live forever. I'm in that bucket.
Look, when you're maybe like 100 and you go to bed one day and then you don't wake up the following day. That's
if I have to go, if I have to go, yes, I'll take that route, right? We'll go that way.
But that's not necessarily the case. So what you need to actually think about is how you pass control of the trust. And there are two things there. One is the trustee role. If you've got a corporate beneficiary, the person that's going to make the call is going to be the directors and shareholders. So a shareholder can sack a director as well. So it's really the shareholders who are in control of the trustee if you've got a corporate trustee. But even more than the trustee, there's a role called the appointor role. The appointor is the person who has the right to appoint and sack a trustee so they can seize control of a trust. Okay?
Hectic.
So you need to think about how you pass on those two roles. Sometimes there's another role called a guardian role as well, which I'm not going to go into.
Okay. So can you just go back on the appointor piece, right? So when you're setting up your trust, let's say I want to set up a trust today. I'm not planning on dying for another 40 years, right? So at least, or ever. But so I need to set up, as well as having outlining who the beneficiaries are, who the trustees are, and all of that kind of stuff. I need to assign an appointor now. Is that what you're saying?
Yes. So when you set up the trust, most trustees don't have an appointor thing. You probably have it in your trustees. I'm assuming you have some trusts. Take a good look at it. And you got to also think about whether that power can be exercised. We've got more than one appointer, whether it has to be by unanimous consent, or whether or how you manage it if they're more than one person. But you got to think about how you're going to pass on that role, both of those roles. So your shares in your corporate trustee, you own that personally, right? So you can pass that under your will.
Mm-hmm.
The role of director, maybe you appoint alternate directors or something. You might also want, you should speak to an estate planning lawyer. So there's things like powers of attorney. When you lose capacity, you can have that attorney take over that role. So if you get dementia or something like that, and in terms of how you pass on, the trustee role, and it needs to interact with your trustee properly. But the assets of the trust, they're not yours. You can't say, I leave that property, which is held in the trust, to my children, because it won't work.
But what about if we think about it differently? And I'm absolutely delighted to be wrong here, but I just want to clarify the point. If the trustee for your trust is a corporate trustee, so a company, mm-hmm. and if the company controls the trust, right? Mm-hmm. But the directors control the company.
Sure.
So if you change directors of the company, then you change the people who own the trust, who can then in turn change the beneficiaries and other trustees of the trust, right? So isn't it just as simple as
shareholders? The shareholders will have the power to appoint and remove directors. So the shareholders, actually, their power trumps the power of the directors.
Yeah. Okay. So let's just walk through a scenario just to break it down in simple terms, right? So let's say me and Gabby have a trust, right? A property trust, right? We're buying real estate in it, and let's just say we've got 2 kids. We don't have any kids, but let's just say we've got 2 kids, and I'm a shareholder of the company. Gabby's a shareholder, and so the company is the trustee for the trust, right? So the company operates the trust. I'm a shareholder. Gabby's a shareholder, and our 2 kids are shareholders, right? So there's 4 shareholders, and then. Me and Gabby and the kids are grown up and they're adults, and we've lived a full and wonderful life. And then Gabby and I are off traveling in outer space or something, which is what we'll be doing in the future. And suddenly we disappear and we never come back, right? So we die.
Sure.
The kids, like if we
the
leave,
way you want to die.
Yeah, the way that I want to die is I want to go into a black hole. That's actually my goal, right? That's how I want to go into a black hole to see what happens at the event horizon, but that's a whole nother conversation. But if our two kids are shareholders of the company, and if we leave our shares in the company to our kids, and then they can appoint a director, then they
can be themselves. They can appoint themselves.
So they can appoint themselves as directors, right?
Yeah.
So they would then take over control of the trust, and therefore we're essentially just handing it. That's a way to do it, though, right?
But you need to actually have it. You should have it in your will, right?
Yeah. So if you've got it in the will, essentially, if me and Gabby have got it in the will that we are going to hand over our shares to the kids and stuff, but more to the point is like the kids would then get all of the assets, right?
Sure, they would. They'd get it in an indirect way, but you need to make sure you leave the shares, right?
Yeah.
And you also need to think about the appointor role too. But what happens if one of your kids dies, but they have grandchildren? Do you have grandchildren through them? How is that going to work? What if they're minors? What if they're 5 years old or something like that? And what if your other child goes all stubborn? So you got to think about all of these things.
Totally. I mean,
they shouldn't because they'll have trustee duties. So you can't just act in your self-interest. But you got to think about all of these things. And what happens if you and Gabby, instead of going off into space and just disappearing, what if you and Gabby lose your marbles?
And do what? And decide to start selling all the properties?
No, you just lose your marbles and you're in some facility, because you can't.
And we haven't set an appointor, so technically
you don't have you haven't put in place a power of attorney. Or what happens if you nominate a power of attorney and they make the decision to take the property, the capital of the trust, and distribute it to someone? Do you want them to be able to do that, or do you want to put some restrictions on that?
Yeah,
so these are things that estate planning is a really important part of trust structuring.
Yeah, I get it. So the planning part, to make sure that no one acts, to make sure that you don't have vindictive kids that take your property portfolio away from you and all that kind of stuff when you just have it.
Or kids who actually don't, when they grow up, maybe they have their own interests and they try to screw each other over.
But let's talk in a best case scenario where it's happy families and everyone's great and everyone takes care of everyone else, right? From the function of being able to, if I buy an asset today in a trust and then 30 years later, I want that asset to be an asset that my kids can have, right? Then the easiest way to do it is essentially, they become directors of the trust.
Sure, that's right. You hand over control of the trust.
Yeah. Okay. Awesome. So,
and that's sort of some of the estate planning stuff, but it is really important when you set up a trust to think about these things as well.
Yeah, totally. I think we could do another episode just on estate planning. So, because what we've covered here is we've covered four key pretty big benefits, right? So there's tax benefits because we can distribute the benefits, i.e. cash, on a discretionary basis to, as long as we're not trying to pay our kids and stuff if they're under 18. You've got the 50% CGT discount, which again has discretionary benefits. You've got the benefit of asset protection so that you are de-risking your position against if somebody sues you or if something happens or if you're a business owner and then that.
The ATO sues you. That's you can be liable for certain things personally, even if you operate through your company, certain tax liabilities.
Why would the ATO sue you?
Yeah.
Why?
So if your company hasn't paid, for some reason you're not in compliance with your super obligations, or pay PAYG withholding, or GST, they can actually pierce the corporate veil, your limited liability as a company, and they can come after you as a director. And super, the liability is forever. It's not like 4 years or something like that, like with other taxes, forever. So you probably want to really make sure you hold nothing else if you're a director.
Got it. Okay, so asset protection is a big benefit. And maybe I'm using the wrong term. Estate planning is obviously a lot more complex, and it's like what happens if it's not a conditional logic. But I would say another big benefit, though, that we touched on there is like how to pass on the assets to the kids, which I think is a huge piece.
There are some, I know that we don't have much more time, Goose.
Yeah.
There are some disadvantages to it.
Yeah.
The trust structure, and there are some pitfalls as well that need to be avoided. I don't know how much. Do we have time to briefly touch on disadvantages before we?
No, actually, we don't. And the reason I'm going to say no is because I think we should do a whole nother episode. Just like this is basically like 4 key benefits, right? That we've got for trust. I think we should do a whole nother episode of like, what are the risks and what are the downsides? What do you think?
Sure.
Because
sure.
I think
it is things to be really wary of. So yes.
Yeah, totally. It's a complex issue, and it deserves not to be glossed over. Like it deserves the time for us to go into it and go, well, okay, so should I run at this at ability gate? Is it for everyone? What are the risks? How do I need to? What's the downside to it? So I think what would be really good, rather than trying to gloss over those items in a couple of minutes, is let's schedule another podcast. And really dig into that, because I think there's a few things that I want to talk about. I think we could do an episode on estate planning. We could do an episode of funding and how to think about funding within a trust and what the implications of all that kind of stuff are, and what's the downside risk or what are the disadvantages of a trust. So what do you think? Are you up for doing a few extra episodes?
Absolutely.
Awesome, fantastic. One thing I wanted to ask you, and it was I thought about this before we started recording, because I already knew that you had gone from a corporate career into starting your own business, and I know that change and all of the impacts that can have. I'm interested to know that in the last 12 months or whatever it is. So since you left the corporate world and started out on your own, what new belief or behavior or habit has most shaped you over that period of time?
I think taking control of my career. So where I want to go, feeling empowered, and sort of, I'm doing some additional study in areas that I'm interested in. I think that it has, in terms of beliefs, I think the idea that we, can take charge of things and that we have choice. So I know your investors are seeking investment in property partially because they want choice and freedom. And I think that's one of the beliefs that has really come to the fore for me over the last 12 months. Awesome.
That's exciting. Are you glad that you did it?
Absolutely. Can't do the same thing forever.
No, exactly. Nice. Well, congratulations on breaking free and for setting up a really amazing business over the last little period of time. And thank you so much for spending time with us. Now, you mentioned a number of times during the episode that you must get legal advice, actual legal advice. And you can provide that advice, just not on a podcast, because you have to provide it on a one-to-one basis to make sure it's tailored to the individual needs. But if someone did want to reach out to you to get specific advice on structuring and tax, tax advice, structuring advice, all of that kind of stuff, where would they go? Do you have a website?
So you can go to my website, so Archway Legal, so it's ARCHWAY legal.com.au. It's got my contact details on it, and you can get in touch.
Awesome, fantastic, Archie. Thanks. It's always a pleasure when we get to chat. I really appreciate it, and I appreciate the fact that you tolerate me running off into different directions and picking apart little different bits. So thanks again for your time. I look forward to chatting next time and really, really soon.
Thank you. It's a pleasure.